Okay, hi everybody. It's Jane here from the membership team at Online Tradesman. You're all very welcome today to our next webinar. Delighted John Molloy from Orca is back with us again today. And if you missed the last two webinars that John did for us recently, they are available in your account under the e-learning section. And I'd highly recommend you go and watch them. There was some fantastic information there, so well worth going back to watch those. So another financial planning one today, and for those who are new to Orca, just to let you know, they're an Irish-owned independent financial services company formed in 2004, and they're a leading provider of pensions and insurance products to Irish businesses. And as an independent company, they're not tied to any one provider, so that's great. You know, you're guaranteed you're going to get the best available rates every time. And just to introduce John co-founded Orca in 2004. I know he'll probably fill you in a little bit more himself on that, but previous to establishing it, he spent almost 20 years in senior management in Norwich Union, Prudential, Irish Life, and Permanent TSB. So it's huge amounts of knowledge and experience there. And just to let people know, as we go through this, you have a little box there, the Q&A on your phone. It's probably down at the bottom. If you're on a laptop, it's on the left. If you click the Q&A button, you'll be able to submit a question. So we'll come to the questions at the end, but as John's going through his presentation, if something comes up, feel free to pop the question in there. Okay, so John, I'll pass over to you.
Thank you very much, Jane. Thanks a million. Can you hear me okay?
All good, yeah.
Yeah, that's great. Thank you. Well, thanks again, everybody, for giving us the opportunity to come in and meet the members and the team in Online Tradesman. And hopefully you've got some added value over the last couple of sessions. This is the fourth of four, so we hopefully will be back in the future with other areas. It's probably the area that I have least experience in is the whole business and succession planning. However, we're quite involved in the inheritance tax side. So my experience when it comes to passing on businesses and acquiring businesses has been that we have bought 5 businesses over the last number of years since we started. So I'm very familiar with the whole process. And we bought it from families and we bought it outside of families. So we have a little bit of background there. So what I'm going to be giving you today is just an overview of some of the areas that you need to be familiar with when it comes to preparing to sell your business, the tax positions that you may or may not find yourself in, how best to look at passing within families or selling, and then the inheritance tax and the potential tax that will be payable through business sales. So as Jane said, if there's any queries, if you type them in there, hopefully we'll be able to answer them. In very technical cases on this subject, particularly in the sale end, I may have to refer and come back to you, but hopefully be able to add some value to you all through the next presentation. It's relatively short, I think of about 12 slides. There's a little bit of detail in each slide, but it's going to be short and sweet, hopefully, and hopefully you'll get something out of it. Jane touched on who we are, and I don't want to, we've done 4 of these already, so that's our offices there in Blackrock on the St. Organ Road. Anyone familiar with the Galloping Green pub and passing by will be familiar with those offices. And we have another office in Portlaoise. But basically, we have a lot of small to medium businesses at our customer base and about 3,000 clients nationwide. Michael Lynch, who's on with us at the moment. Michael is your financial advisor for the Online Tradesman, and Michael is available at any stage to discuss any aspects of the pensions, the business protection, family protection, or any of the previous topics that we covered. Emma runs the office inside here, and she's responsible for all the administration and background. Sarah runs our life and pensions business, and I look after the Orca Financial. We've 1 or 2 other companies within the group, so my job is to make sure they all run relatively smoothly, which can be challenging at times. But anyway, so really what I wanted to talk about today is there's steps to selling your business and what you need to be prepared of if that's the way you're thinking. Considerations that you need to be familiar with if you're passing the business on to the next generation, and the inheritance tax liabilities that may arise should you pass the CGT that will be payable on inheritance or gift of a business. So I'll kick in fairly quickly if I can, and we'll just run through the top 10 steps towards selling your business. And this really just runs through how to sell your business smartly and safely and trying to get the maximum return for you from it. I always believe that once you set up a business, you should pretty much begin immediately to plan your exit strategy. We all set up businesses for different reasons, and it doesn't matter what type of business it is. At the end of the day, there's 2 main focuses. Typically, one is to create value and income for yourself and your family throughout the time you're working there, and secondly, to create some type of value and lump sum for the level of work you have done. But really, it's worth planning and preparing your exit strategy as early as possible, regardless of the reason for exit. And finding the right advisor who understands your selling requirements and strategic goals will be able to help you through those steps. And that really is paramount. There are business advisors that get involved in either finding buyers, finding sellers, helping you get the right exit strategy, looking for the most appropriate buyers, and most importantly, the timing of the sale, the tax consequences of the sale, and the different transactional structures. And it's very hard to give a presentation on that. That alone could take a big presentation, because depending on your business, the structure of your business, the size of your business, there are different types of advisors for each business. We have used a few, so if anybody wants to get referrals for these type of companies, I'd happily pass them on. You just need to get in touch with us at info@orca.ie, and we'll do that. But planning your strategy, your timing of strategy, and getting prepared for exit is key to selling your business down the line. The second area is building your business value prior to sale. So, regardless of what type of business people have, whether it's a one-man operation or a 10 or 15, 20-man operation or bigger, it should be documented, what you have and what your business is, the long-term relationships you hold with customers, your management team, if you have one, the recurring income streams, the streamlined processes. And you should basically always be prepared for somebody to come in and say, I'd like to buy that off you, and be able to pull out a file and document each of these points, because that is really showing that you have a strong business plan and a business worth owning. The third area is trying to determine your business valuation, and this can be quite a tricky task, because many of us who set up business in the past, we did so. My business is set up 18 years ago, and I may think my business is worth a lot more than a person who is coming in to buy it. So owners can often have unrealistic price expectations. Buyers can have unrealistic price expectations, and typically the value will come in somewhere between the two of those. But the sale process can often get derailed by sellers and buyers having completely different expectations about the value of businesses. So what I think is always worth doing, and we do it every 5 or 6 years, is I get a third-party valuation on the business. So I know roughly what a third party, in our case, it's our auditors, do it for us, and they do a full valuation and say, that's what your business is worth. The last time I got done was 2 years ago, and in 2 or 3 years, I get it done again. But in my mind, I have a value in the business, and I think regardless of what business you have, it is always worth knowing what the business is. In addition to that, we conduct internal due diligence on our own business. So this is the fourth point, is that spending a bit of time to evaluate and present your company's financial and business history, future projections, is really, really important point of any sale or to make your business attractive. Again, we have a clear documented here in a file which shows the financials, the history, and the projections we have for the following year. We do a business plan each year, and each business plan is put in, and part of this due diligence shows that we have attained, in the majority of cases, what our goals were for each year. And just to have that in file and to do a due diligence every year to make sure everything is in order is, again, a very good exercise to do. Finding a buyer can be quite difficult. Very coincidentally, I had a customer here this morning who is in the pet food business, and he's in a specialist area of it, and he's turning 60 in a couple of months' time, and he's afraid that he's going to have to work indefinitely because he just can't see a buyer for his business. But after a conversation over a cup of coffee today, we looked at a few areas, and within 15, 20 minutes, he had a couple of ideas of where he's going to go to people who would be looking at buying his business. Buyers can include your existing management team if you have one, strategic buyers who want to have a share in a certain market, financial buyers who are looking for just a recurring income. But every potential buyer is going to have a different evaluation criteria, and there's going to be some disadvantages and some advantages with each. So again, finding a buyer can be tricky. And then evaluating which buyer may best suit your needs is going to be another part. Presentation of the business we have down as number 6, and this again kind of goes back to what I had point number 4. But time and consideration should be given into marketing material for any business deal or business acquisition or passing a business on. A well presented information memorandum, which basically just gives full details and overview of your business, will give a buyer a lot more confidence and the likelihood of successful sale. Your information, this information should capture key credentials of the business: the ownership, the management structure, the trading performance, the opportunities, what's your competitive advantage in what you do, and market data. So all of these, again, can be kept documented. And if there's a knock on your door, if you're going to sale, you pull out a file and you present that. And it's like basically a marketing brochure for your business, and makes it more appealing again for prospective buyers. the transactional structure is, again, very important, and every sale is very different, and consideration should be given to the most advantageous corporate structure for both the buyer and the seller. An example of this is a business we bought about 2 months ago. This was a financial broker's. The individual had been in financial services for 15, 20 years, and we went to buy his business. And if we had bought it the way he wanted us to buy it, which effectively was just buying his book of clients, he would have effectively taken out the money we paid him. He would have to take out and pay income tax on it, and he would have lost probably 50% of the acquisition price. I suggested that we buy his actual company, and in buying the company, it basically meant that the money went into his company account and he was able to take it all out under Entrepreneurial Relief, which I'll touch on in a minute. But looking at the different reliefs, the retirement relief, Entrepreneurial Relief, transfer of business relief, all of these need to be considered, and the right structure needs to be put in place. The only real way to get that done is to employ a very good legal team and tax advisors, and they will get the proper structure put in place for your business. I would suggest anyone who is within 10 years of thinking of selling a business should employ a tax advisor to get a structure put in place now, so that down the line everything is ready, because it can take a couple of years to get the right structure put in place, and it also needs to fit certain criteria which can stretch out for over 10 years. I'll touch on those in a minute. Negotiating a deal, again, is equally important, and success once the deal has been agreed will very much depend on the interactions with the potential buyers, and a strict deadline should be set. You say, listen, we want to have this done by X date, and everything is focused on getting it done by that date. But what we tend to recommend is that you try and put yourself in the buyer situation to get a full understanding of their perspective, what they want and what they're trying to attain. And if you can do that, it'll help with the negotiations, making sure that the interactions between the seller and buyer are kept smooth, because a lot of times these fall down when the nitty-gritty detail is trying to be signed off, and again, it can cause big problems. Legal documentation, again, comes back to the legal team you employ when selling a business. Again, it doesn't matter what size the business is. There are a lot of legal contracts that need to be drawn up when selling a business. And the purchase agreement, which is basically the basis of the sale, or the passover, is going to define all the details of the transaction, and it basically is the definitive document outlining the terms of the sale. The one thing I really can't stress enough is use a solicitor familiar with mergers and acquisitions or SME acquisitions, because I've seen, again, we were involved about 2 or 3 years ago. We were buying a business, and the person we were buying it off wanted to use a family solicitor, and €11,000 into fees. That person suddenly realized that the solicitor just didn't have the expertise to be closing this sale, had to restart, appoint a new solicitor, and racked up another 11 or 12,000 in sales, simply because they were not using a solicitor familiar with mergers and acquisitions. So a legal team familiar with that is very important. Again, we have 2 or 3 that we can recommend that we've used ourselves, and I'd be happy to pass them on if anyone wants to know. And finally, when you do get the proceeds from the sale, it is very important that you consider what you want to do with that. So, good financial advice, mapping out your financial goals to determine how to invest your money to create an income or to do whatever you want to clear debts. Obviously, we'd hope that we can attract some of the customers from online tradesmen, so we can offer financial advice on investing that money. But it's important to review the tax structures put in place at the beginning of the process, liaise with your tax advisor, make sure any changes that need to be implemented are implemented, and you can get out the maximum amount of the value of your business when you decide to sell. So they're just 10 key points for that basically should be considered. I go back to my point 1. Regardless of the age of the business is set up, an exit strategy should be planned, and you should always be ready with the documentation I referred to there that you can pull out and say, here's our business, these are my clients, this is my recurring income, this is what I value it at, and at least that gives you the basis for sale, and it also shows that the business has a good, solid structure in place. If you are looking at passing your business to a son or daughter, there can be significant tax payments made, or there can be CGT reliefs that can be used to try and reduce that CGT payments. Basically, all profits made of a business are taxed under CGT, which is currently 33%. So it's imperative that if you're looking at passing on to family members, that each relief is carefully considered to achieve the most tax-efficient transfer possible based on circumstances. You'll note I have a picture there of the Roy families from Succession, and you can see the hassle there between different families. And I tell you that one, okay, it's fairly aggressive, but it's not unusual when family business are being passed across. So it's important to try and make sure that succession within family businesses are done in the most efficient way possible for the owner, and for the benefit of the benefactor of those. There are three primary areas where you can benefit from relief. These are retirement relief, entrepreneurial relief, and 7-year CGT relief in a small window of circumstances. So I'm going to touch on each of those very briefly. Retirement relief is basically a conditional relief from CGT on the disposal of all or part of a business asset, such as farmland, business premises, family trading company shares. And whilst the name retirement relief would suggest otherwise, it's not a condition that the owner must retire. There's a couple of conditions. First of all, the owner has to be over 55 years of age. The assets being passed over have to be owned by the company for the previous 10 years. That's going back to the importance of planning well in advance for getting out or passing on assets. And where the asset being transferred is shares in a trading company, the owner must meet certain criteria and working director criteria. And again, I think it has to be a 20% director or more for over 10 years. I'm not quite sure of that, but there are certain working director criteria that are needed there in order to pass these on. But where all these conditions for retirement relief are satisfied, the person transferring the business may be fully relieved from CGT on transfers to a child, which includes, as you see there, niece, nephews, or foster children, or child of a deceased child, if these people have been involved in the business. Where a transfer is over 65, and there is a cap put on the transfer of 3 million. So it's quite generous, but there is a transfer cap. Again, if the transfer of assets are not being passed to a child, or as defined above, there is a tax relief, max tax relief of a value cap of 750,000, or if you're over 66, 500,000. So again, there's certain criteria where you benefit by passing to certain individuals, and significantly reduce your CGT, but these need to be looked at, and again, proper tax advice will sort those out for you. The entrepreneurial relief, or revised entrepreneurial relief, caused in 2017, basically means that you can reduce your rate of CGT from 33% to 10% on the first 1 million of sale, which effectively is put down as aggregated lifetime gains on the disposal of business assets. And they include lands, building, goodwill, and company shares. So effectively, if you're thinking of selling a business, I'll go through the criteria in a moment, but you can basically take the first 1 million out and pay 10% tax on it, and then you go on and you pay the different taxes as per CGT rates. When considering the entrepreneurial relief, the main conditions to be noted are that the asset must be owned by the individual for 3 of the previous 5 years ending with disposal. So 3 of the previous 5 years, the owner of the business have owned that company. The asset must also have been used as part of the qualifying business, so it can't just be pulled in and tried to be passed on. It had to be an asset that was an integral part of the business and business use. Typically, that's the premises or storage premises or that. And where the asset is being transferred, whether this relates to shares, there are minimum shareholding ownership and work employee director criteria that has to be met. And again, this goes to 20% director or more, a certain amount of years you have to be employed by. So all of these have to be structured properly before you can avail of entrepreneurial relief. And in doing so, it's important that you have the correct tax advice prior to looking at any sale. The final one is the 7-year exemption relief, which was basically only introduced in 2011 and ended in 2014. And this was specifically designed to try and get people buying commercial premises again. And this is where the government said they would give full relief from CGT, but basically it's a pro rata. Once you bought a building between those 2 dates, and that it was owned for over 10 years. Now, this has been reduced down to 7, and you get 7/10 of the gain or disposal as relief from being assessed for GTT. So it's a slim window, but there are people who had the capital, luckily enough, to buy businesses between 2011 and 2014, and they're able to avail of that relief. Once all these benefits are passed over, inheritance tax comes in, and inheritance tax is again taxed under the capital acquisitions tax banner. And there's there was a lot more, but there's 3 thresholds now which apply for capital acquisition tax purposes. They're as follows. 335,000 is tax-free if the recipient is a child, a minor grandchild of the benefactor if the parent is dead. And in some cases, this threshold can apply to a parent, niece or nephew who have worked in the family business. So if nieces or nephews are a parent who has been working in the family business for a prolonged period of time, they may also qualify for this 335,000. So it's important that you qualify where and who is entitled to that if it's not direct children. If the recipient is a parent, brother, sister, niece or nephew who has not been involved in the business, that limit is significantly reduced down to 32,500. So the first 32,500 can be passed over tax-free. The balance, they're going to pay tax at 33% on. And for strangers and anybody else, 16,250 is the threshold. So this is really designed to be able to pass on businesses or assets to your children or people who have been involved in the business and to get a significant amount of it payable tax-free. Finally, there is the ability to use life assurance to pay inheritance tax liabilities on death. So if businesses are being passed over when the owner is deceased, there can be very, very significant tax payments. So a business worth 2 million being passed to a son or daughter without certain qualifying criteria being reached will mean that the first 335,000 is going to be received tax-free. But if that business is worth 2 million euro, the benefactor is going to have to pay 33% tax on the surplus. So that's 1.7 million at 33%, which has to be paid within 6 months of the inheritance. So what that can mean is that the business will have to be sold. And obviously, people who have spent 20, 30 years building up a business, passing it on to the next generation, would not, in my view, would prefer not to have them sell the business in order to pay the inheritance tax. So life assurance plans can be taken out specifically for what they call Section 72 relief, which basically means that on the death of the person passing the asset, that the benefactor can receive the proceeds of a life policy to pay the inheritance tax, and the proceeds of that policy will not be considered for taxation purposes. So we would work out businesses worth 2 million, you're going to get 335 payable to you tax-free. 1.7 million is your amount you're going to pay tax on. You're going to end up paying about 600,000 tax. We put a policy in place for that. On death of the business owner or the asset owner, it's passed to the benefactor. A life policy is paid out to that effect, which is passed immediately then to revenue, and it's sorted out without any disruption to the business. So it can be a very, very beneficial way to plan for inheritance tax payments that are coming up to avoid the sale of businesses or assets within the family. It has to be paid for by the person who's passing the asset, which can be a bit of a turn-off because it can be expensive. It can be done as a joint life second death plan, which makes it a lot more cheaper if the couple are married or civil partners. So if there's a couple passing on an estate to children, basically it can be on the death of the second person passing it, which basically the life policy becomes substantially cheaper actually. But the policy must be a whole of life plan, so it has to be taken out to pay when that person dies. So effectively, it's not really a life assurance plan; it's a life insurance plan because it will be paid out at some stage because we're all going to die. So that's really a brief overview of of succession planning, selling business, what to be prepared for. The one thing that I will say is that the constant kind of theme through that is proper legal and proper tax advice and planning at least 10 years in advance, because a lot of the criteria that goes with passing on of the tax reliefs you're going to enjoy when you pass on or sell your business will go back 10 years. So you need to make sure that your structures are in place 10 years prior to that sale to maximize the benefit you get from it. So I hope I didn't drag on for too long, 20 minutes, so that's not too bad. And I hope you got something out of that. As I say, Michael and myself are available at any stage to answer any queries or questions you have during this or afterwards, and email into ourselves, and we'll be back in touch with queries. And if there's any assistance we can be on the inheritance tax side of things, the inheritance tax planning side of things, or if you want us to pass on the details of the legal teams we have used and the tax advisors we have used, I'd gladly do so, because I would highly recommend anyone we've used to date. They've all been very, very good. So thank you for your time, and I hope you got something out of that.
Great, thanks, John. Gosh, there was a lot packed into those 20
it was,
minutes.
Well, you know what? When I did it first, Jade, I looked at the slides and I said, God, I can't do this to people at 4 o'clock on a Thursday evening, because there was about 25 slides, and I said, no, we're going to pull this back and just stick on stick on the 3 points, but it was very much just an overview of areas you just need to be aware of. But the whole key is preparation.
Yeah, that's very interesting. And I suppose we would have a lot of people maybe starting out in business who join us and use the service a lot to build up a good client base and build their business, and they may not be thinking of their exit strategy at all. Yeah,
Absolutely.
so I think that's
it's
very interesting.
It's amazing that people, regardless of their of the occupation of what they're doing, don't. But it's not a business. I have to keep on doing it because it brings in my day-to-day income. But there is a value in every business. It doesn't matter. I'll use my plumber who was up in the house on Tuesday evening. I got a plumber in 2004 to put in a new understairs bathroom, and he has been our plumber ever since. He's been there so he's now with us. So 16, 17 years he's been doing anything that has gone wrong. I've got up. And if he sold his business and it recommended that if he was moving out and saying I'm leaving, but I want Joe Bloggs to take over, I would happily take that new plumber on. So, a plumber that has a client base of 40, 50 people or 50 or 500 people that ring him on a regular basis should document all of these clients that ring him regularly. They're regular clients, look at the recurring income, and there is a value in that business. It doesn't matter if it's an individual sole trader, a company, everyone's business has a value. And it's just a matter of making sure that that value is documented, illustrated, and retained. And regardless of what an individual perceives their business at, there is a value in every business. And if it can be well presented, it's worth something.
Yeah, very good. I have a couple of questions here, and there's one actually on valuation, just wondering about if they are passing on their business and there is a workshop and equipment as part of that. Is it taxed at the same amount? How is it valued? Who values it?
Well, so there's two slightly different questions there, and I can't answer both properly, but I'll be able to do my best on this. The first valuation is that the business equipment will just be valued as per your auditors or accountants, and they look at what the business equipment is, the property, and equipment. Equipment tends to depreciate quite quickly in value, so that's depreciating. But business premises and assets that are used as an integral part of the business do qualify for those reduced reliefs. So when they're passed on, they're passing part of the business. If you're passing it to one of the criteria that niece, nephew, son or daughter or parent that's been working in the business, they will qualify under those. If not being passed to those, they're just going to be valued at any other asset, and they're going to be added to the price of the business. So your building will have a value, your assets will have a value, but I would suggest that the asset values depreciate an awful lot quicker. Your building will be going up probably at the moment, and your assets are going to be going down. Who will value it would be, I would suggest the initial valuation should be done by an accountant or auditor. And then if you really want to get into a serious sales mode, there are business valuers who will go and do a specific value for you.
Yeah. And I think you've probably answered this already, but there's a question here about, does the 7-year exemption apply to a workshop premises? I would assume it would as a commercial premises.
I would assume if it was bought between those years, and I'm not sure, Jane, if you had to. I doubt it very much, but I remember when the legislation was brought in to try and encourage people to buy property, there was an influx of people buying property for that reason alone. I don't know if they had to register it as being part of that relief, but the dates I've given there between 2011 and 14 are applicable to the reduced CGT rates. And again, it is quite a big incentive not to pay CGT on an asset that has probably grown very, very substantially since acquisition.
Okay. And there's another one here about handing a business over to a nephew. I know we've so many of our members actually have family businesses, and they've, in some cases there's been the father and then the son. We've a couple of generations even in some of the members. And somebody here asking about, what about handing on to a nephew, not a child? I think you've covered that.
Yeah, but there is a relief that's actually specifically called, and it's quite sexist, but regardless of whether it's a niece or nephew, it's called favourite nephew relief. And it's actually a registered relief within revenue. So again, it'll be, so if there's a niece or nephew working in the business and had an active part for over a certain period of time, they will qualify for these business reliefs. So and you'll also qualify for the relief. So it's again, it needs to be, there is a relief there, but it needs to be qualified exactly by a proper tax consultant to make sure it's structured properly for you.
Okay. And we've a Another one here. So just considering a name change to my business name as it uses my surname, does a business name increase or decrease the value of a business?
Hello, Jane.
Sorry, I think we lost our connection there for a
Oh,
second.
yeah.
You
Oh,
can
I
hear
can
me?
hear you now. Yeah,
Yeah.
I can hear you now.
So,
Yeah.
yeah, we've a good question here just about business names. So we've Andrew here is saying, I'm just considering a name change to my business as it uses my surname. Does a business name increase or decrease the value of a business?
Think, well, it depends very much on the business. You'll see from our windows here, Orca Financial is the name of our company. And when I was in college many years ago in 2000, I was doing a degree in UCD. One of the very first thing was a marketing course, and it was said, try not to call the business after your own name, because when you're trying to sell it, people, if I called it, my business partner was Stephen Byrne, if we called it Molloy Byrne Financial Services, Molloy and Byrne are an integral part of that business. The fact that Orca is there means that we're not really integrally tied, and we can sell Orca Financial. It is not necessarily Molloy and Byrne. But depending on the business, I know certain legal firms like to have their name. The name of the business would be, John Molloy, legal advisors. But really, it depends on the nature of the business. I would think, in general, that a brand name that is not a surname is more advantageous for the seller, because they are not linked to the business when it goes to sell. So I'd say it probably puts a little bit of slight increased value on it, but I don't know how much.
Okay. And another question where somebody's going, is my best first contact to be an accountant or a solicitor?
I would suggest that if somebody's looking to sell the business, their first contact should be their own accountant.
Yeah.
So we'll all have somebody doing the books, and if somebody, whoever does your payroll or your books at the end of the year, your own accountant will be quite familiar with the nature of the business. At that stage, then they should be able to recommend you into a legal team or a tax consultant. I wasn't going to mention any of the names, but I use a company called Clark Hill Solicitors, and Clark Hill are a legal team. They've been involved in all our mergers and acquisitions to date, but Clark Hill do both legal and tax advice. So I go into Clark Hill, and they'll also set up a tax structure within their own business. So it's very handy for us to have it all in house. So I would suggest a good legal team with tax advisors will be the second port of call. Others may not want to go to their accountant, and at that stage, depending on the business, I could recommend a few different legals that will also give you the tax advice needed. If it gets quite complicated, they'll refer on to a specific tax advisor, but in the main, they're quite simple. And you get the legals, you get what they call the share purchase agreement, the SPA drawn up, and then at the same time they will have the correct tax structure put in place for the acquisition. So both are being done by the same company, which is very handy for us.
Yeah, and from that story you mentioned, it certainly sounds like getting the right person with the right experience really is so important to not be overspending money unnecessarily.
Absolutely.
Yeah.
Well, I was surprised that it was actually a financial broker was prepared to sell his business without fully understanding the best way to get the money out. Like, as I say, he was getting a sizable lump of money that he would have lost half in inheritance tax if he'd done, if we had done the sale the way he liked. But by buying his company, everything that went into the company, he could take it all out under the Entrepreneurial Relief rule and just pay 10% tax on. So it worked out very beneficial for him.
Yeah. Okay. I'll just double check. Have we any more questions? We still have everyone here with us. Yeah, just checking. I don't think there's any more. But look, if anyone does have any specific questions, info@orca.ie, or you can drop me a message in the membership team. I'll gladly pass on the details then to you. But John, thanks so much. That's great.
Thank you, Jane, and thank you all for allowing us invade your Thursday evening. And I hope we managed to add some value. And if there's anything at all we can do, Jane has our contact details, our info@orca.ie. We're available at any stage just for a chat on the phone, and any direction I can help you with or add any value I can add to you, I'd be delighted to. So don't hesitate to call.
Okay, thanks everybody. And
Lovely.
a recording of this will be available in your member account from tomorrow, so you can watch it again. I know there was quite a bit of information in there, so I'm sure you've been taking notes, but you can watch it again and again, so it'll be there tomorrow in your account. So thanks again, John.
Lovely. Thank you very much, guys.
Recording.